Hello, Business 630 class. This is Professor Hassey. This is our week 3 Monday lecture for corporate finance for the week of November 8th to the 14th. And the key point of this week, which will take up most of our time with this lecture today, is our case number 1 risk analysis case. For a lot of you, this is a new experience doing casework at the MBA level. And so I want to walk through and go over what I'll be looking for, what are the requirements and the rubric for this work, and making sure you all are comfortable with your work as you start out this first case study in APA format called Risk Analysis and Interpretation. We'll also talk about the topics of this week, which is stocks, equity investments, how to calculate a stock price using discounting and required rate of return. We're going to go over the capital asset pricing model, which is a key part of your case number 1 risk analysis. Also, we'll be talking about the return on investment for equity and how it includes the overall capital valuation of a company. But those calculations for stock we'll handle in our Friday video. Today, we're basically going over the case number 1 study, which is 20% of your course grade. So I want to make sure you all are comfortable with it. I also have our class office hours on Thursday, which I'm sure some of you will be coming on to ask me some questions about the work or any interpretation. And feel free to include that in your weekly schedule if you need any help with this case. I strongly urge all of you to start your case number 1 work as soon as possible. Don't wait till Sunday evening to do the case. This case will require about 4 to 5 hours of work at minimum. Some of you maybe even more. So take that into account in your schedule planning this week. A couple of additions to our Blackboard site this week. Remember, this is our first grade in the course. So as you post your work by next Sunday, your first grade for this course will be in the report card section of your Blackboard, so you can see how you did and get your file returned back to you. Remember, all of our video recordings and introduction videos and Friday videos are always posted to 2 areas: the Zoom YouTube links file folder or your individual file folder of that particular week. Remember, if any of you have questions or have need answers, we have the question and comment section of the discussion board. And so please take advantage of that. If you don't feel like sending me an email or coming to Thursday night student hours, post a question to the question and comment section. This week, in week number 3, our subject is the risk analysis. A couple of files that I urge you to look at, and we'll be looking at some of these files in just a moment. I've given you a sample case paper, just a sample of an APA format, which I'll be looking for as how the paper is formatted. Not so much, don't pay any attention to the information in this sample, but how the case or how the work should be formatted. Also, I give you and we'll discuss a rubric about how I'll be grading this case number 1 work. The key topics this week are equity financing. And as it says here in this description in our Blackboard for the week, capital financing can be summed up very simply as the decision a company needs to make to finance its operations and fixed assets by either obtaining capital by the borrowing and paying the debt over a specific period of time at a specific designated cost or interest, or exchanging capital for ownership stake in the company, with the cost being the expected return the stakeholder requires in order to justify the investment. In other words, I'm going to invest in Tesla if I expect Tesla to pay me an expected return over into the future. If Tesla does not pay me that expected return, I'll probably sell the stock. What is expected return? Dividends and stock appreciation and value, stock price growth. There's a third area of capital financing that I don't include here, but I probably should, is naturally the use of profits from prior periods. But some companies don't have that many profits to invest in capital, so I kind of left it out here. A key part of this analysis of equity financing is understanding the concept of risk premium. The market risk premium can be calculated by subtracting the risk-free rate from the expected equity market return, providing a quantitative measure of the extra return demanded by market participants for the increased risk. The risk-free interest rate has no risk. The expected market return has average risk, or a beta of 1. We use this formula in discussing and calculating the capital asset pricing model. The capital asset pricing model describes the relationship between systematic risk and expected return for assets, particularly stocks, the particular company that you're looking at, and their risk in the market. We're going to talk about that. On Friday, in our Friday video, we're going to be looking at the constant growth stock pricing model, how to determine what we think a stock price is going to be in the future by using a constant growth model. We'll also talk about the second example of determining stock value is the discounted cash flow method of determining stock price. These are two important concepts to understand in understanding what it takes to finance a business through equity. Now let's take a look at the first case study. Remember, in this class, we have 4 case studies, each worth 20%, and then an individual case study paper and analysis called a capital budgeting analysis, which will be discussed and posted next week. That also is worth 20%, and that is due the last night of class, December 19th, the last day of class. 2 works are due that December 19th. That capital budget analysis that I was just mentioning, and case study number 4. So technically, if you're into numbers, we have 5 case studies during the course of our classwork, each with different motives, different ways of doing things, and each one is worth 20% of your grade. That's the grade in this course. This first case is called risk analysis and interpretation. Taking the company that you all selected in week number 1 and doing a risk analysis of looking at their credit rating, their capital asset pricing model, or their return on equity in the current market, and also determining their out of market risk and interpretation. We'll talk about that in just a minute. So your job is to take and go to the internet and find specific information by looking at the financials of your company, by looking at the credit rating of your company, and doing some analysis and interpretation on that information, and to put it in an APA format paper. And we'll talk about that in just a minute. Remember, this is graduate study. You are entitled to put some interpretation and papers together professionally. There's no misgrammar, no spell check errors. Everything is clean. References, interpretations, analysis. These are all expectations of your work at this level. And I'll talk about that expectations in just a minute. So the case is split into a couple of parts. The first part is mainly a calculation, risk evaluation. For the company you selected, prepare a risk analysis. That risk analysis is at a variety of levels. What is the credit rating of your company currently? What is the Standard & Poor's, the Moody's, the Fitch? Those are the 3 credit agencies or rating agencies of corporate America. What is your current company's credit rating? Another area of risk evaluation is what is your company's current beta? You're going to need that company's current beta when you go to the next step, the capital asset pricing model. What is your company's required return on equity investment today? And I give you some of the values that you're going to need to determine that by giving you today's current risk-free interest rate, which is 1.45%, and the current market risk return in the market of 7.75%. You take those 2 variables plus the beta of the company, and you can determine the expected or required rate of return on equity investment using the capital asset pricing model. I also want you, for the sake of future case studies, is tell me the current capital structure percentage of your company. In other words, go to the most recent quarter. If you have the information, go to September 30th and find me what percent of the balance sheet of that company is in debt, what percent of the balance sheet of that company is in equity. The two should total or will total 100%. So that debt can be a combination of current and long-term. Equity can be a combination of stock, retained earnings, and some other things depending on the company that you have. I want to know what the percent debt and equity of your company is as of its current financial quarter. And for most of you, that would be September 30th. Not required, it's optional. But if you do find this information, I'll give you some extra credit points. What is the current, this company's that you selected, current weighted average cost of capital? If you can find that on the internet and give me that information and explain the source where you got it, you'll get some extra credit points, preferably about 5 extra credit points. So if you get a 95, you get this problem correct, you get 100. You get an 85, you get this problem part correct, you'll get a 90. What is the current WACC of your company? This is not required, so don't anybody get all stressed out about it. What is the WACC of your company and where did you find that information? Maybe you calculated it yourself. We'll see. The second area of interpretation, and notice it's 65 points of the total grading of this paper, a majority is what is the organizational health and environmental risk in the market of your company? Is your company have some organizational problems, management difficulties, lawsuits, everything related to the sustainability of your firm's future viability? Is your company got a strong management team or a weak one? Do they have a lot of lawsuits, or are there markets changing and there's some insecurity there? I want you to explain that to me. And what is the environmental? Everything that's happening outside of your organization that could affect either your firm's success or organizational health. If your company is makes nuclear reactors, I would think the environmental risk of your company is pretty great. Not too many political or social issues now support nuclear power. Very tough for sustainability and pollution. What is market, inflation, industry, competition, political, social risk of your company outside of the credit rating, the beta, the capital asset pricing model? What other risks are involved in your company today? Key takeaways to these two parts. Risk analysis seeks to identify, measure, and mitigate various risk exposures or hazards facing a business, investment, or project. What are the risks to your company, both economically, socially, organizationally, to your business today? A quantitative risk analysis uses mathematical models like the capital asset pricing model and simulations to assign numerical values, credit rating, beta. Qualitative risk analysis relies on the firm's subjective judgment to build a theoretical model of risk for a given scenario. That's what organizational and environmental risk perspectives are. Risk analysis is often both an art and a science. The art part is your interpretation of your company. Risk analysis is a process of assessing the likelihood of an adverse event occurring within the corporate, government, or environmental sector. Risk analysis is the study of underlying uncertainty of a given course of action, and refers to the uncertainty of forecasted cash flow streams, the variance of portfolio or stock returns, the probability of success or failure with certain projects or investments, and the possible future of economic states. In other words, a big risk right now for a lot of companies is inflation. What's another risk to companies now? In organizational health, you can't find enough people to work. Supply chain management. I want you to look at all these factors in doing a risk analysis. Presentation. This is going to be an APA format paper. What's an APA format paper? Probably most of you have already done those already. Title page, an abstract page, references, double space text, Times New Roman 12-point font. Geez, Mr. Hassey, lighten up. No, welcome to graduate study. If any of you work for companies and if you've ever put together a presentation, you have a company culture, a company template of how you want to represent data to the market, to the public for your business. You have to follow the rules of how the company wants it to be. My rules here, Times double space, Times New Roman, 12-point font. Don't have that, you won't get an A. The minimum is 5 pages. The maximum is no more than 10 pages to this document. Here's a link to APA format if any of you want some more specific information about that. But as you can see in just a minute, I'm giving you a sample of the APA format. So you people think, geez, 5 pages? What am I going to write about in 5 pages? Well, number one, as you'll see in our format, 1 page is for the title page, 1 page is for the abstract page, and 1 page is for references. That's 3 pages right there. So naturally, you're going to need probably more than 5 pages, hopefully, if you do your work correctly. Here's a sample case paper, and I'll show you, this has already been posted to Blackboard. This is a case number 1 risk assessment of a company called Best Buy. Fortunately, Best Buy was not selected by any of our students in this class, so that's why I'm giving you this format. I've blocked out certain things that I don't want you to see, but notice the title page. Notice the abstract page. This explains what the paper is all about, what you're trying to do. Then the risk evaluation, giving me the information about their credit rating, capital asset pricing model, their beta, all the information requested in that first part. Also, maybe a sample or using charts, graphs, however, I like to see that in documents. In this case, this person gave the balance sheet of Best Buy and explained the capital structure of the company with this balance sheet. Any way is up. Any way is fine. Then the risk perspective, organizational health, environmental health, these are all samples. Doesn't mean you have to include these. Maybe in some cases, I'd like you to include more, but it gives you a general idea of what I'm looking for in this case. And then finally, a reference page explaining to me where you found your information. Very important, because trust me, I randomly check these for your papers. And notice this is a 9-page paper. The maximum is 10. And the person who submitted this work got an A for this work. This is an example of an A paper. So use this as your guide, but do it in your own personal way, your own personal style. But this is the basic format that I'll be looking for. Here's the rubric and how I'll be grading this work. If you notice on the case, it says the first section, the risk interpretation or analysis is 35%. The second section, the organizational health, the environmental review of the risk associated with your company is 65%. And involved in that 100%, the paper, how you organize your paper, the focus of your paper, you're specifically sticking to your abstract, that's worth 20%. The risk evaluation, your analysis of the credit rating, capital asset pricing model, capital structure percentages, credit rating, that's 20%. The risk perspectives, organizational health and environmental, 20%. The abstract support and elaboration, your references, your use of data, how you prepare and how you show your interpretation, 20%. And your presentation, no typos, clarity, easy to read, easy to track. Your APA format presentation is worth 20. I grade you on all these 5, and you'll get back when I return your paper back to you next week. You'll have each one of you will have an individual sheet like this, and you'll see my evaluation of your case work. Okay. So going back to Blackboard to week number 3 under week 3 in-class review, you will see the sample case paper and the rubric for this case to download and use as examples and sources of information. But the key thing to remember in this paper is I want to see you locate data, interpret data, and explain data as is asked in the case paper. And put it in a clear, concise way, not with a lot of blah, 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 specific points, specific information, specific interpretation of what I'm looking for in this paper. And by the end of this paper, once you complete it, you will be able to fully give a good explanation and risk assessment of the company you selected. What is this risk in the market with its credit rating? What is its risk in the market with beta? How is this interpreted in a expected return, the capital asset pricing model? How leveraged is the company? What's their capital structure? What percent of the company is in debt? What percent is in equity? And in taking this statistical or qualitative information and doing a quantitative analysis of organizational risk and environmental risk, and summing all that up into an abstract that kind of tells us what's your interpretation of your company on November 8th as far as risk is concerned in this world market that they participate in today, this week. That's what I want to see. Should take you about minimum of 4 or 5 hours to gather the data, put it all together. Looking for some creative and good thinking on this from you all. If you're having difficulty grasping this, look at the samples, look at the rubric, sit on it for a few days, review it, and then come to our student hours on Thursday evening and ask me some specific questions. And then you'll give you the following 3 days to finish up the paper. And then you'll be ready for my Friday video, which explains the calculations of equity financing, constant growth model, discounted cash flow valuation. All these are very important in determining the value of stock. What is the capital asset pricing model? One of the main sources of what you read in that article last week. You might want to apply some of that thinking to maybe some of your interpretation of the risk of your company. That would be a nice thing. And some of you might not see any warrant in that. That's okay too. And that's why we read the article last week, to give you a different perspective. The capital asset pricing model is a way of determining the expected rate of return on a company's stock in relationship to the risk in the market. What are the risks in the market? Risk number one, the risk-free interest rate. The risk-free interest rate has a beta of 0. And more preferably, depending on who you ask, but in this class, it's the 10-year U.S. Treasury yield. That's what the risk-free rate is. Now, different circles, different finances have different interpretation of what represent that rate. But I think it's fair to say in this class and general thing that if you take the 10-year United States Treasury yield currently, that's your risk-free interest rate. It has no risk. It's cheap. Another interpretation also of the capital asset pricing model is the market return rate. This is a beta of 1, which is the average risk in the market. And usually it's the S&P 500 current market return. Now, again, in other sectors of finance, they might use the NASDAQ return or some other indicator. But again, a safe assessment is to take the S&P 500, the Standard & Poor's 500 listing of stocks and the index, and what is its current return in the market. That's the average return in the market. Another key number or another key area is the market risk premium. The market risk premium is the risk between average risk, beta of 1, and zero risk, a beta of 0. In other words, the market risk premium is equal to the market return rate minus the risk-free interest rate. That is the market return premium. That's spread, okay? Right now, if I would look this up, per my example over here on the left, the current risk-free rate is 1.75. The current market return rate is 8.5. These rates are a little bit different in your case number 1, I might add. Remember, the risk-free rate has a beta of 0. The market return rate has a return of 8.5, and that is a beta of 1. The market risk premium is the difference between 8.5 and 1.75%. That's the market risk premium. That's the delta between average risk and zero risk in the market today. That risk-free premium is multiplied times the specific risk of your individual company, beta, and then that number is added to the risk-free rate to get the capital asset pricing model expected return on investment. So in the case of this company, 1.75% is the risk-free rate. The market premium is 8.5 minus 1.75, which is 6.75%, times 1.5, you get 11.88%. So if I wanted to buy whatever this company is stock, I would probably look to make sure that I'm going to buy this stock today. I can make sure I'm going to have a expected return on investment in the next year of dividends and market growth of 11.88%. That's based on today, the risk in the market versus the risk of this company in the market. Beta 0, beta of 1, and in this case, a beta of 1.5. What is it for your company that you selected? I give you the risk-free rate. I give you the market return. You have to determine the market premium. You determine the beta, and you can give me the expected rate of return on your company stock as of today in your paper. I want you to calculate that. And notice the capital structure, which you'll also be finding in question number 1 for your company, is what percent debt is of assets, what percent of equity of assets, and they must total 100%. So that just gives you an outline of what we're trying to do in our risk analysis, and also this cost of equity and the capital asset pricing model will lead into our Friday video discussing stock valuation. Again, this spreadsheet is in your week 3 in-class review, so you can have that as a source of information. So we're off and running for week number 3. Basically, this is our, this is the end of the first third of our course, more than a third, almost 30%, 40% of our course of the 8 weeks. But also it leads us into our next discussion next week of capital budgeting, how to combine all these risks, how to combine bonds and stocks and financial information into determining what's the future hold for our business as far as risk management and investing in the market, capital assets. That leads us into our next discussion beginning next week in week number 4, chapters 9 and 10 of your text, but more importantly, capital budgeting. And a whole slew of fun things are going to be drawn off of that. So good luck this week with your case number 1. Think, take your time, get the information, and put it all together. I'll be available on Thursday evening at 6 o'clock for student hours, and I'll see you again on Friday with our Friday video doing a little bit more calculations of equity valuation. Thanks, everybody. Have a great week. We'll see you later. Adios.